Hi there, it's Charles Thomas from Intrepid Eagle Finance. I'm here to reflect upon the first quarter 2025 for the market and the economy. Looking at a couple of headlines up front on the positive side of things, global diversification boosted returns for U.S. investors. That has not always been the case the last couple of years, but it was a clear benefit. We'll talk about that. Germany is dramatically increasing defense spending, and the UK is spending on housing and infrastructure. Recent macroeconomic data suggests the labor market is still relatively solid. Inflation has declined to 2.8% from the last reading we had in February. Now, looking more on the cautionary end of things for what we're watching, uncertainty when it comes to tariffs, trade wars, all of that, that is front and center right now. That is reason for a little bit of caution right now. Consumer sentiment, consumer confidence, that has declined as of late. We look around skepticism that we're starting to see around the feasibility of the Federal Reserve actions, that's starting to creep in. And we look at just US stock market as a whole. First quarter did have a very slow start. We'll dig in a little bit more. That was heavily impacted by some of the seven biggest companies. And again, we'll revisit that some more here. A couple of numbers I'll just share with you off the top for things that stood out to me from this quarter. First off, the 4.25% to 4.5%. That's still the Federal Reserve's range where they want to see interest rates. Now, labor markets are relatively resilient, still more progress to be made on the inflation front. The Fed is kind of taking this stance of wait and see. 65.2, it's another number that stood out. That is the latest reading on the Consumer Confidence Expectations Index. So essentially what that means is US consumers' expectations for future income, job prospects have declined. And just to give you a comparison to that, it's at about the lowest level in the last 12 years. And that's why this has started to crop up and got some attention. Some people, not all, but some people look at this particular indicator of consumer confidence and they believe it might be early signs of a recession. Again, there's not complete consensus on that. 10.9%. Mentioned at the outset, international stocks did well for the first time in a while. They outpaced US stocks in the first quarter. The difference was noticeable. It was a near double-digit return difference between international large cap and US large cap stocks. And in an effort to try to save the most interesting and probably the most reassuring number for last, it's negative 0.3%. That's the year-to-date index return for a globally diversified portfolio of 60% stocks, 40% bonds. With all the market volatility, you might be surprised to know that this sort of stock predominant investment mix is essentially flat for the year. Let's talk about tariffs. Now, one of the biggest narratives for the first quarter was undoubtedly tariffs, which will be covered in the next couple of slides. But before diving in, it's important to remind ourselves why tariffs are typically used and what implications they carry with them. So remember, tariffs are paid by the domestic companies importing goods, not directly at least by the foreign companies importing them. Those costs can be passed on to the consumer in the form of higher prices. Sometimes the company can eat the difference, but sometimes they choose to pass it along. Now, rationales for planning tariffs, they can be things like protecting certain domestic industries where cheaper goods are available abroad. They can be used to influence another country on a particular policy issue, which could or could not be related to trade. Could be to generate government revenue. Could be to encourage local production of a good or even a service. So there can be some national benefits to tariffs, which is why you see numerous countries use the policy. But this can have some side effects. Tariffs can beget and turn into more tariffs in the term of a trade war, can become tit for tat. They can cause consumers to spend less. They can cause a slowdown in economic growth overall because prices are rising for the effective goods. And this can also make it a challenge for companies to do business and supply chains for ordering products and inventory become more expensive than they might otherwise. Now, whether you think tariffs are a great idea or a terrible idea, one thing that I think is an easier thing to agree on is the policy has been fluid. What you'll see on here is a chart that shows some of the actions that have been taken, and they have evolved as these have started to come out. So as of the end of the first quarter, there were multiple tariffs enacted and proposed, include a number of country and product specific tariffs as well, along with some broader blanket policies. It's important to know that all the information I'm discussing here related to tariffs is prior to April 2nd. I'm sure you've seen stuff has happened since then, but we're focusing on what occurred prior to the beginning of April. Now, when you look at White House policies around tariffs, as I said, they've proven to begin to be fluid. The graphic on here gives a list of prior to April of tariffs that have either been proposed, enacted, or canceled. Now, it's not only that tariffs can, but the uncertainty that can happen when you take something on again, off again. Again, whatever you think of them, the easier thing to agree upon is that if you're a business owner or you're working on a supply chain for a business, you would rather have a more certain environment than an uncertain environment. Now, ultimately, the outcome of these tariffs is going to depend on how long they're around and the magnitude, the size of them, and how much they are. Now, the other thing to keep in mind is tariffs do not affect all industries and products equally. There is quite a bit of difference when you look across the spectrum of our economy. When you look at this chart here, it breaks out between products that are affected by indirect or direct impact for tariffs. Now, what does that mean? Think of indirect in that I get the materials or the supplies needed for my product from another country, and then at least some of that assembly or production is done in the United States. The direct is for products that are made entirely or almost entirely outside of the US. So if you look in this and think about what does that comparison look like? Well, you can see pharmaceuticals, huge impact. There's a tremendously high percentage of pharmaceuticals are manufactured entirely outside of the US. Now, if you were a proponent of tariffs, this is one of your biggest examples for why this is a problem for us as a nation and why we need to have that in place. Fair enough. Now, the other side of that is if you put this in place, then something is going to happen to recognize those new higher costs and place for that. That part of the equation typically comes first before there's manufacturing or shifting of supply chains to be able to account for that. That is in huge contrast to something like we look at for housing. As you expect for housing, that's an almost entirely domestic, and it's the indirect impact where a lot of their materials come from abroad, and then the actual assembly or the use of the products happens here in the US. Completely two different sides of the coin there. Looking outside of inflation and looking outside of tariffs, looking toward inflation. Because tariffs policies are quite new and have not been completely enacted yet, we haven't seen an upward rise in inflation that we can tie to that yet. However, as you can see on this chart, inflation has proven to be sticky as of late, giving further credence to the Fed's guidance that the last mile, that they're calling it, getting inflation from 3% down to 2%, is going to be a challenge, and that is proving out so far. The potential effect of tariff policy could make this more challenging. If you're looking for the Fed to continue lowering interest rates, what we would likely need to see a material downgrade in economic growth or labor market for them to be able to justify that. And I do want to recognize on this, this is an environment for inflation where we're way better off than where we were. I'm so happy that we're not at those levels you see back in 2022, but we're still not to the long-term inflation rate that we saw for the last decade prior to 2020. From 2010 to 2020, you would have seen inflation closer to that 2%, which is much more palatable for the economy and for individual consumers. Now, looking out at this curve that we've seen, this is an interesting chart I came across recently. So what you've got here is you've got it plot out for the inflation rate from 2014 through the present as measured through the green line. That's the path of inflation from the 1960s through the 1980s measured by the blue line. It is often referred to in that period as the Great Inflation, which ushered in an area of stagnant economic growth and high inflation. If you lived through that era, that was not a pleasant part of living at that time. The inflation trajectory of these two time periods look more similar than we would like, but their underlying causes are not quite the same. The first one was caused by a multitude of factors, including an oil supply shock, the removal of the gold standard, and expansionary monetary and fiscal policy. Today's environment's much different, but the stakes are just as important. Inflation were to pick up again like it did in the late 70s, and the employment rate were to take off, the Fed would be in a difficult position. So with all that said, if you're at the Federal Reserve right now, it's a very difficult position you find yourself in. Ideally, the Fed would like to lower rates due to good news, like seeing inflation decline. However, they can also lower rates due to bad news, like challenging economic conditions, like they did in the Great Recession or during the early part of this decade. Tariffs, if they prove to be inflationary, could also be a factor as part of the economic growth outlook. Similarly, if unemployment worsened, the Fed could potentially lower rates for that. Now, unemployment and stable prices, those are part of the Fed's mandates. It's difficult to know which one of those two they would decide to focus on if they got a different story between the two and got opposing signals. Now, I mentioned at the beginning around consumer confidence has seen a little bit of a dip. Now, when you look at the uncertainty that's out there, you can kind of justify and say like that's would cause at least some people to maybe be a little bit less confident on the economy. If you look at this chart, this comes from the University of Michigan Consumer Sentiment Index, and you can see it has declined. Declining consumer confidence can be an issue because it can be a precursor to declining consumer spending, which we'll show on the next page. At the same time, this chart also shows S&P 500 returns have been significantly higher in the 12 months after the sentiment hits a trough than it is when the consumer sentiment peaks. Now, indicators of consumer sentiment and consumer confidence, both of which are in decline, are similar in that they measure the mood of consumers and their overall willingness to spend money. Now, negative sentiment is one thing, but when it flows through to markets, that's another thing altogether. Now, while that previous chart points out how consumers are feeling, this chart paints a picture of how consumers are expected to alter their spending habits between must-have items and nice-to-have discretionary products. As you can see, the S&P 500 basket of stocks for consumer discretionary companies has declined in recent weeks toward the end of the quarter, suggesting that investors are starting to focus more on consumer spending on big ticket items such as cars, washing machines, and phones. Consumer spending is an important economic metric for us as a nation because it's two-thirds of our economy. Now, this highlights two key investment concepts. Because many economic indicators are backward looking and markets are forward looking, it's very difficult to make market deciding decisions based on the economic indicators. And two, that the future holds a wide range of possible outcomes. And because of that, diversification, not putting all your eggs in one basket, remains essential. Let's take a look at some individual parts of the market, how they fared in the first quarter. First, looking at bond returns. Now, US bond returns were all positive in the first quarter. Only non-US bonds fell slightly, returning about 0.2% in the negative. Over the last 3 months, Treasury and corporate bonds have outpaced municipal bonds. One analyst shared this quarter that the Treasury corporate versus muni difference, it's largely driven by the yield curve reshaping in the muni market with long-term yields increasing. So in other words, munis have also been negatively impacted by these sorts of spreads, the seasonal weakness, and also heavy issuance. We're seeing municipalities borrow much more than they have in recent years. Now, all bond returns shown on this chart are positive over the last 12 months. The big standout is short-term Treasury inflation protected securities earning the most at about 7.4%. And that's largely due to declines in short-term Treasury yields. On this slide, if you focus on the chart on the left first, you'll see that compared to year end, short-term rates stayed the same over the quarter while long-term yields fell slightly. And the chart on the right is the municipal bond curve. Importantly, you can see that it's shaped differently from the Treasury curve. Different factors drive each market, so it highlights how different types of bonds can move differently at various times for different reasons. Now let's look at the quarter's performance for US stocks. US stocks were mostly negative for the first quarter, with the exception of large cap value stocks. Uncertainty around tariffs, trade wars, etc., continue to weigh on US stocks across the market cap and valuation spectrum. Large cap growth fell around 10% year to date. Now, over the last 12 months, large cap stocks across the spectrum all returned to over 7%, while small cap stocks fell between 3 to 5%. Looking a little bit more closely at stocks in the US, if you've seen this presentation in the last couple of years, you've heard me talk about this phenomenon we saw and got named in the financial press as the Magnificent Seven. And what that meant was when you look at the 500 different companies in the S&P 500, the seven biggest did substantially better for the last couple of years than the other 493. If you look on here, it's broken out by the S&P 500 as a whole, and it breaks out by those two groups I just mentioned. And if you look at the difference between them in 2023, 2024, substantial difference. It's haves and haves nots for sure. And that's led to that group of stocks being very, very heavily top weighted. Now, what we saw in the first quarter was almost the exact opposite of this. We saw the 493 smaller companies by themselves were up while the Magnificent Seven were down. Now, balanced out between the two when you add them all together, that led to overall being down. But that just shows you how big of a reversal that is compared to what we've seen in the last couple of years. Now, speaking of negative performance, volatility and market pullbacks are not enjoyable by any means to experience, and that's why it's important to keep a long-term mindset. This chart Details growth of a dollar in the US market from 1926 through the end of last year with an overlay of 5 to 10%, 10 to 20, and 20+% drawdowns or declines. Now, this tells us two things. One, drawdowns, however much we don't like them, they're common and they're to be expected. Doesn't necessarily make them easy to deal with, but we need to keep the possibility of short-term losses in mind as a part of when we take on investing. And number two, no matter the level of persistence of these drawdowns, what we've seen in the past, history shows us that markets appreciate in value over time, over the long term. And the best way to be rewarded for the risk we take is by remaining invested. Now, investors see the sentence, past performance is no guarantee of future results all the time. In fact, if you zoom in and look, you'll see it on this slide right here. But too often you hear that investors don't follow this mantra. In good markets, investors expect the good times to continue, and when the markets are down, investors can sometimes have a hard time seeing the sunny skies that are in the future. Looking back here using a century of data, this chart gives a little bit of context for how returns over the next 100 days look like when the previous 100 days was a decline of more than 10%. But what you see is the majority of the time, about 6 out of 10 times, the return was positive in the 100 days that followed. It's certainly not sunny skies, smooth sailing all the time, but it's not necessarily dark clouds either. Looking outside the US at international stocks, non-US stocks on the whole had returns in the positive territory for the quarter, with the exception of international developed large cap growth. The non-US stock indexes that we list here are all positive for the 12 months too. International large cap stocks gained a little over 6%, outperforming their US counterparts. Now, interestingly, international large cap value has outperformed US large cap value by over 20% year to date. Now, if you're going to take away one thing from this slide, here what I would say is non-US stocks from the recent months highlight the value of diversification. Now, relating back to the previous slide, markets have now begun to notice the exceptional 15-year run we've had with the US markets relative to our global peers, that the US market is less than a drop in the bucket. The quarter's less than a drop in the bucket relative to history, but international stocks have been a big win in portfolios year to date. The winners of the prior decade, like the S&P 500, those Magnificent Seven stocks I mentioned, all those sorts of things have weighed on global performance. Looking at the strength of the dollar, this is a comparison of the US dollar to other currencies around the world, 16 other currencies. Now, just as a reminder, a rising dollar is generally good for us as US consumers. It makes foreign goods cheaper to purchase, but for owners of non-dollar stocks, it hurts you. And the exact opposite is true as well. So what we've seen is the US dollar continues to be very strong, historically speaking. It declined a little bit over the quarter, but a US dollar decline would be a tailwind for non-US stock returns versus US stock returns. The opposite of that is also true, though. And in closing, just some reminders about things that are important for us to keep focused on. Financial planning is a process, it's not an endpoint. Concentrate on long-term goals and objectives. Focus on reaching goals, not on beating benchmarks. Maintain discipline in good and bad markets. Invest broadly, globally. Your asset allocation is key. We want to reduce investment and tax costs where possible, where reasonable, and rebalance as necessary over time. And that takes us to the end. I want to thank you for joining me. Thank you for your time and your attention today. May the Lord bless you and your family.